Well, good afternoon then, folks, and just another update from us as we approach the end of another week of trading. End of another week, and then end of another month today, end of a quarter today, and also end of half of the year. It is 2020, or halfway through 2023. Where does the time go? But anyways, we'll get stuck in the markets. We'll see what's gone on over the course of this week, which has been dominated by speakers out of central banks. We've had the ECB President Christine Lagarde, we've had Jerome Powell, Chair of the Fed, we've had the Bank of England Governor Andrew Bailey, and the Bank of Japan Governor, the new Ueda, in or out speaking over the course of this week at the ECB's forum on central banking, giving their thoughts on monetary policy going forward. Now, we had a panel discussion the other day where they discussed monetary policy, and again they've reiterated their hawkish stances, suggested they're going to continue hiking interest rates. Even Jerome Powell did not rule out 2 in a row interest rate hikes going forward, and yeah, all the governors of the central banks, heads of the central banks, continuing on with their hawkish stance, which markets continue to defy and continue to push higher. We'll start with a couple of the other things of note. The IFO business climate, again, negative when it comes to Germany. That didn't really impact markets too much, as we're rocketing higher in terms of the DAX over the course of this morning. Apart from that, some positive durable goods orders, which, in terms of what it means for markets at the moment, it's a little bit tricky to wrap your head around. I mean, on one hand, positive data means the Fed can keep their foot on the gas in terms of interest rate hikes, which means that should be negative for stocks. But on the other hand, positivity surrounding the economy is then positive for the growth of the stock market. So, I mean, in terms of being able to work this calendar out, judging off the price action is pretty tricky to work out. I mean, I was reading a lot of macro hedge funds over the course of the first half of this year have struggled. A lot of them are at a loss to begin the first half of this year. So, in terms of reading into the macros to try and predict direction going forward, I mean, interest rates where they're at, global economy slowing, and central banks not being able to get inflation under control and having to continue hiking interest rates to the point or on the verge of hiking some of these economies into recession. That's no way that's positive for stocks, but they keep continuing to rocket higher, which is difficult to wrap your head around from a macro perspective. But from a technical perspective, the trend is your friend, and if something continues to go towards the top right hand corner of your screen, a lot of the time it does continue to go towards the top right hand corner of your screen. So that is something you need to keep an eye on going forward. Trend is your friend. Say don't fight the Fed, but markets are fighting the Fed at the moment. The market's seemingly winning. But apart from that, in terms of actual data out throughout the course of the week, not really a great deal, with some inflation prints out of Europe, which we'll get onto in a minute. Yesterday, you can see some GDP figures from the US, which I want to touch on for a second. You can see some positive growth figures out of the US. Consensus 1.4 versus a final quarterly figure of 2%. So that's still extremely strong growth in Q1 from the US. So that economy is not faring too badly. Let's see how they fare over the course of Q2. Certainly no signs of a recession just yet in terms of the US. Apart from that, with some positive inflation out of Germany yesterday, some positive inflation out of Spain. I say positive, but higher than consensus inflation out of Germany and Spain yesterday. Then comes around to France and Italy over the course of this week, slightly below consensus, and brings us into the CPI print this morning from Europe as a whole, which is obviously down substantially from the 6.1%. 5.6 was the consensus versus an actual of 5.5. So, a clear decrease in the rate of inflation. You can see the core CPI 5.5 consensus versus a 5.4 actual, which is a slight uptick, but the headline figure is down. But markets have not really seemed to care. As you can see, markets continue to push higher over the course of this week. A strong aggressive move on the DAX, pushing higher, the FTSE pushing higher, the Nikkei even getting on board. But you can see the S&P, the Dow Jones, the Nasdaq, and the Russell all having fun in today's trading session. Then you come around to the US dollar, which the US dollar has risen over the course of this week, and this uptrend in the dollar from last week is continuing on into this week, and that's not something you see too often. An uptrend in the dollar and an uptrend in US stocks, that's generally around positivity around the US economy. You'd see something like that. But when it's an interest rate, markets don't really seem to care about interest rates. You'd expect them to care, but they don't really seem to care. So it's pretty difficult to wrap your head around, certainly from my point of view. Macro hedge funds seem to agree with me, and you know what that means for markets going forward. You've got yields rising, you've got the dollar rising, you've got stock market rising, which is not a combination of things you likely to see too often. So something we do need to keep an eye on as we head into next week. But yeah, you can see the Aussie downside, Kiwi downside, Euro dollar downside, cable downside. You can see dollar yen, dollar Swiss choppy, but is grinding higher, and dollar CAD has also risen over the course of this week. But that dollar yen is something that is of note. Obviously, I've been highlighting on these videos over the course of this week and last week at 145 level. Be interested in it, and we did have a bounce back off it over the course of this morning's trade. That's the first move away from it. Not central bank intervention. You're likely to see much more aggressive move off the back of some intervention from the central bank, but a clear rejection of 145. Pretty simple trade in the overnight session. Into today, you can see yields pushing higher as I suggested. You can see oil grinding higher again, has bounced off the 67 round number to the downside, but overall remains a choppy chart to look at the moment. But you can see each time that you bounce off this level down here, you get to here you bounce off of here, get to here, bounce off of here, get to here, bounce off of here, get to here. If you do bounce off of here and only get to here, and you make your way back down towards that 67, surely that falls at some point over the course of next week. But it does get up and breach through these highs at 72, 72.50, then that'll cause me to rethink. But certainly as of now, if that does retreat from where it's at now and decides to push back lower, back down towards that round number of 67, surely that is a decent trade to the downside on oil and opens up further moves or potential for some further moves. In terms of this afternoon, we've got core PCE out at 130. We'll cover that in a later video in the pre-US rundown. But as of now, positivity in markets over the course of this week. Stock index is up, certainly aggressively to finish the week. We've had the US dollar higher and US yields higher. Not a combination of things normally that you would see, but something that we will keep in mind going into next week, as that relationship may not last forever. But markets are fighting the Fed. The trend continues to be your friend, and that's the side of the fence that you'd probably prefer to sit on. Stock index is higher. Anything material changes, we'll be sure to update in future videos.